Hi Accounting 2. In this video I'm going to go over what a note payable is. A note payable is a formal agreement between two parties. So one party will be lending the money, one party will be borrowing the money. In Accounting 1, we learned about a note receivable. In Accounting 2, you are going to learn about a note payable. A note payable, one more time, is a formal agreement between two parties. It's different than accounts payable in that it's a formal agreement and one party will have to pay interest or receive interest from the two parties. Accounts payable and notes payable are both classified as liabilities. Accounts payable is most often a current liability, whereas notes payable can be current and long-term. Okay, so let's look at the board. I have an example that is the same as in your PowerPoint. So a company purchased inventory on 10/31/2021 for $45,000. The interest rate is 8% and the note is for 6 months. Very important that we see the total time period for the note. You can, with a note, you could purchase, this example, purchase inventory, or you could borrow money from a bank. So if you borrowed money from a bank, you would get cash. In this case, they're purchasing inventory, so they're going to get inventory. Over to the side is the computation to compute interest. It's P, which stands for the principal. That's always the amount borrowed. R stands for the interest rate. That's whatever the interest rate is in the problem. And then T is the time. The time will be the most difficult for you. For our class, interest will always be on an annual basis. So it will always be over 12. Even if it's a 5-month note, a 2-month note, an 8-month note. The denominator will always be 12. It's the numerator that you have to really think on what that number would be. All right, so let's go back to this example. They purchased inventory on 10/31/2021 for $45,000. You write in your date for the inventory, and then you debit inventory. Okay, remember, inventory is an asset. How to increase an asset? With a debit. So debit inventory, $45,000. And credit, in this case, a note payable. So credit note payable. Now that's your first journal entry. Of course, there's no interest at that time. For this particular problem, you borrowed this note on 10/31/2021, but the note will not mature until 2022. So you are going to have to do an adjusting entry. Remember, when you do an adjusting entry, cash will not be affected. The closing period for this example is a calendar year, which means it closes on December 31st, 2021. So as of that point, this company has to close their books. So they have to complete all their adjusting entries. Remember, adjusting entries are completed at the end of a period. So the first thing I'm going to show you how to compute is interest. All right, so we go back here. It's 10/31/2021. So count with your fingers. When I teach in class, students are like, Professor Clay, that's a little elementary. So what? Use your fingers because it's going to make you go slowly with this. All right, so 10/31/2021. You will not start counting until the next month. So you'd count November and December for that year. So that's 2 over 12. Now finish it out. You're going to take the principal, which is $45,000. You'll multiply it by the rate, which is 8%. I like decimals, 0.08. And then times 2 over 12. So 45,000 times 0.08 times 2 divided by 12 equals $600. Okay, so now you're going to make an adjusting entry for $600. Remember, you're borrowing. So interest in this case for you will be an expense. You go over here, don't touch cash, don't forget that. Okay, so you go over here and you label it accrue interest on note. So we're going to debit interest expense and that's $600. And we're going to credit interest payable, $600. That's telling us we need to pay it. We have not paid it yet. We will not pay it until it matures. Okay, so when will it mature? All right, you borrowed on October 31st, 2021. So you got November, December, January, February, March, April, 6 months. So it's going to mature on April 30th. So you go over here, all right? Now let's go back here. How many months did we already recognize? We already recognized 2 months. So in the next period, you could do it 2 ways. I'll show you. If you did it this way perfectly, then you can just subtract. So the total time period is 6 months. You can take the 2 months that you already recognize and subtract it, and that would be 4 over 12. But let's double check it. So we already recognized November and December. It's going to mature on April 30th. January, February, March, April. 4. Let's do our equation. It's 45,000 times 0.08 times 4 over 12. You divide this out. 45,000 times 0.08 times 4 over 12 gives you $1,200. Okay? Now that's the interest for 2022 only. You already recognize 600. Don't double count. Let me show you what you do. So now we're going to finally pay off on this note. So we go back to our note payable. We're going to take that off the books. So I debit note payable. $45,000. Okay, second thing, I'm now paying this interest. So I'm going to take my accrual that I've already recognized off the books now because I'm going to pay this total interest. So I go back here and I debit interest payable. That's clearing that account out for $600. Okay, now I need to recognize the interest expense for 2022. So I go back in and I debit interest expense for $1,200. Okay, now I'm going to credit cash for the total. So I go over here, credit cash for the total. Add it up. 45,000 plus 600 plus 1,200 gives me 46,800, and that's a credit. That's crediting cash. I'm now paying off this note. I'm going to show you a check that I do at the end. Now this is just a check for the total cash piece. Here's what I do. I take the note, which is $45,000. I multiply it by the interest, 0.08. And I multiply it by the total time period, 6/12. That gives you 45,000 times 0.08 times 6/12. That would give you 1,800 plus, I add in my principal, 45,000. And that gives me the same as what I have over here, 46,800. And that's it. That's how you complete a note payable. I'm going to have, again, separate videos for different liabilities.